Tim Rosen here. Just wanted to visit with you for a moment. I wanted to relate a story with you. I was in a doctor's office with my wife just the other day waiting for her, and a kindly older gentleman saw my shirt just like this one here. I was at the office for a while, so I came in with my shirt, and he says, "Financial compass, huh? Help people pick the right stocks?" And I said, "No, sir." And he said, "So, what do you think about the Facebook IPO?" And I told him, well, anyone who would give me a moment and would listen to me, I would warn them against it. He seemed to agree, so I thought that he didn't participate in the whole initial public offering of Facebook. And then he said, "Well, I bought at 41 and it's down to 31. Think it'll come back?" And I was trying to be polite and respectful, but my answer was, it's not likely and I really don't care. See, stock picking and market timing is akin to speculating and gambling. Why do that? This older man, I don't know how much money he put into it, is down 25%, watching it daily, waiting and hoping for one company stock to go back up. That's one of many reasons why we don't engage in stock picking. Look, if all of the managers of the big mutual funds out there, all your retail mutual funds have a manager, and it's his or her job to stock pick, to create this fund of stocks to do well for you, the investor, after fees and such. Well, they don't seem to be doing a good job at all. The average mutual fund manager buys and sells stocks within their portfolio. 96% of all the stocks are sold within 1 year, replaced with other stocks. What does that sound like to you? Active stock picking. So if the average stock stays in the portfolio less than a year, that's very inefficient, very costly. And if you haven't sat through and learned from my class called Separating the Myths from the Truth in Investing, you need to call the office and schedule a time to do that. There I line out the facts for you of which managers have beat the market, for how long, can they stock pick. And the bottom line is, if these professionals can't, what makes you think that you can, or listening to a stock tip is going to help you? This gentleman in the doctor's office then said the following. He was going to educate me and said, well, you know, the market's going to be down for another month and then it's going to go up. Again, biting my tongue, trying to be respectful to the person. I responded, I said, well, sir, it sounds like you're stock picking and your market timing. Is that correct? And he kind of shrugged and knew where I was going with that. Stock picking and market timing do not work. The markets move randomly. And with over 300 million investors in the world, they determine stock prices based on free markets and the law of supply and demand. Yes, certain events can momentarily affect the market. That does not mean that you need to ask yourself, gee, what do we do? Greece is defaulting on their bonds. What do I do? What do I move around? Oh, presidential election coming up. What do I do? When you have a prudently diversified portfolio that owns a cross-section of these different asset categories such as emerging markets, international small cap, and we actually own the markets, it's already designed to benefit from the ups and downs. It's your behavior that we need to manage, and that's the importance of coaching. If you're watching this video and you're our client, you need to get in the game and participate and come to the coaching classes. We're in this together. It takes both of us. You need to know and you need to learn what does not work so you can avoid them. Learn what does work and why. So when, not if, when you catch the news of the next bad news, the next downfall of this country or this company or something political, you don't have to stress and have anxiety wondering, what does this mean? What do we do? You don't have to. As a matter of fact, as I record this, your portfolios, if you're a Financial Compass client, your portfolios are being evaluated for rebalancing. This is a huge benefit, especially in down markets. You may notice that your account is down, but look, investing is for a 20-year period, not for the month, not for the year. And during these down times, we're actually analyzing your portfolios and looking to see, well, let's see, your fixed income is up, and it is up above our preset level, and your US is down. We're going to sell some of your fixed income that is up, which is a profit. You're supposed to sell when things are up, and we're going to buy more of what you have that is down. Now, what do you think that does to your portfolio long term as we stay disciplined to continue to sell when things are high and to buy more of what is down low, buying them on sale? It's going to mean profits for you. And that also helps you and helps me to help you stay disciplined even during down times. And we're going to face more, but opportunities are there. Yes, we're going to have a presidential election. Yes, we're going to hear more from Europe and the euro and our country's overspending. Doesn't mean that it's going to be easy. It took a Carter to get a Reagan, I'm just saying, but we made it through. But you're globally diversified. Don't give in. Don't give in to the temptation to listen to someone's predictions because they're always wrong. It's great for selling books, bad for your portfolio. Mark your calendar for August 30th, our next class. This is your opportunity to get in the game and as a player to be coached to help increase your peace of mind. August 30th, 2012, Hampton Inn, 6:30. And I'll be teaching a session called The Right Time to Panic. So don't miss that. Call the office and RSVP and we'll see you then.